Hi friends, welcome to the channel GIB and CIB Made Simple. So today we are going to discuss our CCP unit number 1 and the chapter name is Principles of Lendings. So this is the very basic chapter and it will help you understand what are the things that we keep in the mind while lending. So let's get started and with our first concept, which is regarding the safety, right? So what safety is all about. So this is the basic rule that every bank follow before giving the loan. Right, let's keep it super simple. So this is the first and foremost principle that is called safety. Safety means can the borrower actually repay the loan? This is the key point. Basically ensuring that borrower can repay the loan. And the bank check the customer financial history and reliability. Two things bank check. First of all, it check the financial history. And second thing is check is the reliability. Right. So the point is the safer the borrower, right? The safer the loan. The safer the borrower, the safer the loan. This is the point, right? So this is the first thing that's called safety, right? The safer the borrower, the safer the loan. Second thing is, liquidity. Liquidity means what? So I will explain in detail regarding all this point, right? So as you can see, the point they have mentioned that borrower can repay the loan. So protect bank fund by lending only to rebel borrower. So what is the rule? The rule is very simple. Higher credit worthiness. Let me explain. So liquidity means, the bank should get its money back quickly whenever required. That is called, ability to convert loan asset bank to cash when required. That's called liquidity. So that means, that's why bank prefer loan that are short term so that they can meet withdrawal need of the depositor at any time. So bank always prefer, short term loan, right? So loan should be structured so that bank can meet withdrawal demand of the depositor. So whenever depositor demand withdraw, so they can easily facilitate that. So that is why bank ensure short term loan. So short term loan, higher liquidity. Very basic thing. This is the rule. Short term loan, higher liquidity. So one example I can give you that bank prefers short term working capital loan to maintain the liquidity. Right. This is the key point. The third concept is profitability. So, bank are businesses. They must earn profit from the loan. Obviously, bank is completely business. And since it is business, so they must earn profit. They must earn profit from where? They must earn profit from loan. Right. This is the key point. So profitability simply means and earning enough interest after covering the bank cost of fund. Right. So that is the formula that how much interest you have earned subtracted cost of fund. So you are earning enough interest after subtracting the cost of fund. That is called profitability. That means ensuring that enough interest after covering the bank cost of fund. That is called profitability. Right. Loans should provide a reasonable return relative to the risk. So bank earn interest from fixed term loan which boosts the profit. The next thing is purpose of the loan. This is another important point. That's called purpose of the loan. So bank always check why the borrower need money. Right, that is called end use of the borrowed fund. Bank always check why borrower need money. Bank always check. So only productive, only legal, only safe purpose are supported. And you think that if the purpose is useful, right? Like suppose it may be business expansion, right? So in that case repayment chance actually increases. So you can see productive use, higher repayment ability. That's called the purpose. The next point we have is the diversification of the risk. So basically, bank never pull all their money in one type of borrower or one sector. They never pull all their money. They never pull all money in one sector, right? Or, one type of borrower. They spread loan across, agriculture, retail, industry, a small enterprise. That's called, you can see now, lending to SME, agriculture, retail, and industry. So basically, this is called diversification. So more diversification, risk is lower, right? So remember, the three golden pillar of lending is safety, liquidity, profitability. This is the very important point. This is called, student life plan, easy to remember, SLP. Safety, liquidity, and profitability. These are the three basic points. Obviously, purpose is also important. That why borrower need money. And the last is diversification of the risk. This is super important. So now let us go through the important rules which we have gone through in this particular discussion. So see, this is how we have, created this particular content. I have first of all tell you the basic concept, some formulas or some rules which we have to keep in the mind, and then again we will revise the formula and then do some MCQs. So this is the very efficient technique to learn the concept. Basically, whatever we are learning, we are focusing on, exam relevant content. That what kind of question can be framed from this particular content. That's what we are focusing on. So let's see the important rules. The first rule that we come to know is that, profitability is what, profitability is equal to how much interest you have earned and what is the cost of fund. If you subtract cost of fund from interest earned, this will give you the profitability. Second thing we have discussed, that liquidity strength is based on short-term loan oblique total loan. Means, how much short-term loan you have as compared to total loan. That gives you the liquidity strength. And the third thing we have just gone known, that is called SLP. What is SLP? Safety, liquidity and profitability, which is the core principle of lending. So now let's do some MCQs. Now the question is, what is the primary concern of a bank depositor? Options they have mentioned: high loan demand, profitability of bank, safety of their fund, government policy. So the question is asking you about the concern. Obviously, high loan demand is not a concern. Profitability is never a concern. Safety is not a, yes, obviously, safety is a great concern, right? So safety of their fund is the main concern of the bank depositor, right? Depositor mainly want to ensure that their money is safe. Now the next question they have asked, what is the meaning of this term so-called diversification of the risk? Giving more loan to one big borrower, lending only to government entities, spreading loan across, yes, correct. That's called diversification. You are spreading the loan across different sectors. Now friends, let's switch our focus to the next part, that's called, principles of lending. Let's discuss it. So the first concept here is, fiduciary relationship. So, what is the meaning of fiduciary relationship? Basically, a bank hold public money in trust. You know it very well, that a bank hold public money in trust, right? So this means that bank must use people deposit safely, legally, and only for productive purpose. Right. See, the keywords are you have to use fund for safety, legally, and productive purpose. Because RBI regulate bank, the public has high confidence in them. Right. Who regulate bank? Obviously, none other than RBI. And since RBI regulate them, so public has high confidence. Public have high confidence in them. Right. So that is the point, that bank hold public money in trust. And the bank must use people deposit safely, legally, and only for productive purpose, right? So one example they have mentioned, that bank must deploy deposit in safe, legitimate loan. Second point they have given is the obligation to repay deposit. What does it mean? So whenever a depositor asks for their money back, whether on demand or on maturity, the bank must repay it. So you can see, banker must return deposit on demand or maturity. The bank must repay it. And except for current or call deposit, bank must also pay interest. In the case of current and call deposit, no interest is paid. And in rest all cases, interest should be paid. So that is called, obligation to repay depositor. Right. So friends, what we have discussed, the rule is that, deposit repayment consists of two things. First thing is demand and maturity repayment. That on demand you have to repay, on maturity you have to repay, right? And second thing is banker must pay interest except current and call money. So one example they have given, that saving deposit must be repaid when demanded with applicable interest. Suppose in the bank there is a customer and he has a saving account and he has a deposit in there. So the bank obligation is to repay the depositor whenever he demands the money with applicable interest. That's the point. Friends, we have content available for CCP. If you want videos, if you want PDF, if you want mock test, you can check out. And in the video we have started from unit number 1, and this will continue till last unit. We will cover in the same fashion. As you can see, if you want to get complete video lecture, then you can enroll in our CCP course. Description you can check out in the description section of the video, or you can WhatsApp me on this particular number for more detail. Now the next thing is liquidity management. You know it very well that bank receive money. This is the bank, right? And it is receiving money from thousands of depositors, right? And numerous depositors are there. So they must always keep enough liquid cash ready to handle withdrawal at any time. Yes, they should handle withdrawal at any time, because the customer can demand money at any time. So banks should have enough liquidity. Banks should have enough liquidity to handle the withdrawal at any time. So basically the rule is that, higher deposit, it means higher liquidity requirement. More deposit means higher liquidity requirement. That's it. So large number of depositor, bank must keep adequate liquidity. That's the point. Next thing is, so one example they have mentioned that bank hold liquid asset to repay depositor anytime. Now the third point is income generation and recovery. Income generation and recovery. What does it mean? So loan should do two things. Two things the loan should do. First of all, earn income, income for the bank. And the second thing is that come back safely, right? So when I say good lending, it means, three things: income plus safety plus timely repayment. So three things are there in good lending: income plus safety plus timely repayment, right? That's the point. So bank ensure that borrower can repay with interest. Now, next point is loan as a major income source. Please understand. The main income of bank come from giving loan and earning interest on them. So lending is a prime earning activity of the bank, right? So what is the main source of income for the bank? So obviously they give loan and obviously they earn interest. Giving loan and earning interest on the bank. That's the main source of bank. So efficient, safe and smart lending is crucial for bank profitability. So right, efficiency is very much important. Smart and safety lending. So friends, always mention these four words. What we have learned. See, bank profitability is two things. Bank always invest and bank also, earn interest from the loan. So profitability depends on these two things. How much interest they are earning and how much this investment they have done. But if you compare these two, out of these two, obviously loan is the major income source. So that's the point. So whenever explaining lending, always mention safety, liquidity, income and repayment. Right? Please remember it. Now, let's look at the key rules which we have discussed. First of all, we discussed about the fiduciary duty. I told you that bank hold public money in trust. This means that bank must use public deposit safely, legally and only for productive purpose. Right? So that's called, safe, legal and productive use of deposit. That's called, fiduciary duty. Second point is deposit repayment. When I say deposit repayment, what does it mean? It simply means, that amount plus interest, right? So bank must for the depositor, bank must give the principal amount and obviously the interest. Except current deposit, in this case no interest is paid. And SLIR, already I told you, safety, liquidity, income and repayment. These are the memory, these are the core duty of the bankers. Now friends, let's do some MCQs based on the concept which we have discussed just now. So first thing is that why do bank receive large amount of public deposit? Option A, higher interest rate. Option B, no alternative for saving. Option C, public confidence due to RBI regulation. Option D, high stock market return. What do you think? What is the major reason? That's why bank receive large amount of public deposit. So if we talk about, public confidence due to RBI regulation is the major reason. Right? Bank receive large amount of public deposit because of the public confidence due to RBI regulation. Now what about question number 2? It says that which of the following is not a duty of the banker? Tell me. Which of the following is not a duty of the banker? To manage liquidity, to ensure safety of fund, generate income, ignore repayment commitment. So the duty of the banker is not a duty. Let's see here. Manage liquidity, this is the duty. Ensuring safety, duty. Generating income, duty. But ignoring repayment commitment, this is not a duty. Actually, they have not to ignore, right? They have to take into their consideration. Now, the next part is, lending as a major income source. So friends, we will understand why lending is the core income of the bank, why it involves risk, and how bank can act like a financial intermediary. These three things we will cover one by one. First thing is that lending as a major income source. A big portion of bank money is used for giving loan, right? Obviously, the big portion, also suppose this is the portion, the big portion is being used for giving the loan. This is the pie chart, right? So these loan, what these loan do? These loan generate interest. Yes, you get interest, and also which is the main income of the bank. You know it very well. So if the bank lend efficiently, its profit will automatically increase, because lending is a major activity. And if it is lend efficiently, if they lend efficiently, obviously profitability will increase. It will directly impact the profitability. So bank income consists of two things: income from interest from loan plus other investment. The next point is lending involve inherent risk. What does it mean? Let's understand. So lending is never risk free. Lending is never risk free. Borrower may delay payment, borrower may default, borrower may face business loss, right? Three things I am telling you. They can default, they can delay, they may face business risk, right? So individual cannot lend efficiently because they don't have the skill or information to judge who is trustworthy, right? So individual cannot lend efficiently. Why? Because they don't have a skill, they don't have information, they don't have risk assessment ability. Obviously, that's why individual cannot lend efficiently, because of the lack of the skill, information, and risk assessment ability. So that's why bank handle this risk professionally, right? So the reason is high information gap, higher lending risk. So larger the information gap, larger the lending risk. For example, take the case of a person. He don't know which borrower is trustworthy. Bank handle this, professionally. That's the point. Next thing is bank as a financial intermediary. Bank act like a bridge. So this bank act like a bridge, right? They take money from people who have extra fund. So see what bank is doing. People, right? And what he is doing, he is lending directly online to other individual, right? Direct lending. That is called peer-to-peer lending. Since there is no bank doing check or verification, the chance of default, delays, or even fraud are very high, right? So direct online lending between individual saver and the user, that's called peer-to-peer lending. Higher default risk because bank professional appraisal is missing. Yes, that's why default risk is higher, because appraisal is missing. So the rule is that P2P lending, high default probability, right? One example is the P2P loan may face delays, non-repayment, or fraud. Now, the next point is cause of lending risk. So risk does not always come from dishonest borrower, right? So let's talk about the cause of lending risk. Risk does not always come from dishonest borrower. Sometimes business fail because of the market downturn or competition or changing prices, right? So even honest borrower may struggle to repay. Why? Due to external condition, right? That's the point. So sometimes what happens, that even you have the honest borrower, but they are not able to repay. The reason being external condition is the factor. So what we have learned just now, let me just explain. So what we have discussed, two important rules, that borrower default risk depends on two factors: internal factor plus external business factor. And a business may fail due to declining industry demand. Industry demand may decline, and because of that, a business may fail. Right. So always write that risk is not dishonesty. Even good borrower fail due to market condition. Right. So this is a very important thing. So 2 to 3 rules which we have just gone through. Let me just write it down. So first thing we have discussed is the lending risk. Lending risk include default risk plus delay risk plus business risk. These 3 risks are included in the lending risk. Then we discuss, so question may be asked that what are the inherent risks inside the lending? So that may be lending is never risk free. They may delay payment, they may include default, or they may face business loss. Second thing I told you, that intermediation flow, which means bank act like a bridge. They take money from people who have extra fund and give it to people who need money. That is surplus unit, bank to deficit unit. That's how intermediation flow happen. Then we talk about RIDC. So RIDC is just a trick to remember. Risk, there are what kind of risk we have just discussed. So risk include repayment issues, information gap, default, and competitions. Right. So these are the major sources from which risk can arise. So let's do some MCQs based on whatever concept we have discussed. So the first question is, why can't individual efficiently undertake lending? Option A, they don't have money. Option B, they lack appraisal skill and borrower information. Option C, lending is illegal for individual. Option D, they don't want to earn interest. What do you think? So basically, individual can't efficiently undertake lending because they lack appraisal skill and they lack the borrower information. Because of these 2 reasons, individual can't lend efficiently. Option number B is the correct one. What about next question? The next question is, which of the following is a major cause of lending risk? Option they have mentioned: high saving rate, borrower integrity alone, adverse business cycle, high government tax. So why is there major? What is the major cause of lending risk? That's the question. So the answer is adverse business cycle, right? So this adverse business cycle is major cause of lending risk. So that's the reason. Now friends, let's switch our focus to the next part, that is safety of fund. So safety of fund is a principle that the loan must be repaid safely as per the agreed term. That is what safety is all about. Safety of fund, right? So basically when I say safety of fund, it means the bank should get its money back safely as per the agreed schedule, right? Before giving the loan, the bank check two things. What the bank check? First thing the bank check is that whether the borrower or enterprise had the capacity to pay or not. So whether the borrower or enterprise has the capacity to pay, first thing. And the second thing they check is the willingness to pay. Two things bank must check: willingness to pay and capacity to pay. Please note it down. Capacity means what? Can the borrower generate enough income? Or willingness means what? Willingness means that is the borrower honest, is the borrower reliable. So honesty plus reliability, right? This thing bank check. So capacity means can the borrower generate enough income? Willingness means is the borrower honest and reliable? And finally, the loan must be used for productive purpose. That means so that repayment is possible from future profit. Productive use of the loan so that repayment is possible. So let me give you one example of it. So as you can see it here, that a business that earns a steady profit can repay loans safely, right? Then comes borrower appraisal. Appraisal. What is the meaning of this term appraisal? Appraisal simply means that verifying everything about the borrower. So friends, remaining discussion we will done in the paid class. If you want to get benefits of all these lectures, you can enroll in our CCP video course, CCP comprehensive course, which consists of PDF,